Welcome to rrptechnologies.com. This video is a follow-on to my first video about portfolio optimization. I'll be sure to leave a link to that video in the comments so that you can watch that one if you'd like. Some of the items that I discuss in that video will not be discussed here, so I do recommend that you watch that if you have a chance. So in this video, I am going to optimize a 4-security portfolio or 4-ticker portfolio. I'm going to select Apple, NVIDIA, QQQ, which is an ETF for the NASDAQ 100, and finally TLT, which is a long-term bond fund, long-term treasury bond fund. And what I'd like to do in this video is I'd like to compare the output for 2 different investment periods. You can select up to 4. In this case, I'll be selecting 1 year and 5 years. And in both cases, the optimizer will return a portfolio with volatility minimized as much as possible. But the assumption here for this portfolio is that you would hold it for 1 year, and for this portfolio, you would be holding it for 5 years. All right, I'm going to just move on to the next page. What we need to do here is we need to select a target return. And I'm going to select a pretty aggressive target return of 20% for the 1-year portfolio and 20% for the 5-year portfolio. Now, something that I should point out is that when you indicate 20% here for the 5-year portfolio, what you're saying is that you would like to have the optimizer construct a portfolio with minimal volatility that will have a mean return for each of the 5 years of 20%. So to have that behavior every year for 5 years is more difficult than it is here. And when I say more difficult, I mean the optimizer will have to select, will have to put more weight, more cash into riskier stocks. And we'll see that in just a minute. So I'm going to now click on Optimize. Right now it's thinking. And the optimization is finished. This is the price graph, which I discussed in the first video, so I don't think I'll cover that here. Also, this is the returns graph, also discussed in the first video, so I don't think I'll discuss that here. The optimal portfolio is represented by this purple curve. What we're looking at here is a, well, you could call it an upside down cumulative distribution graph. But this is, I think, a nice way to represent risk and return. In this case, the portfolio crosses through this horizontal green dotted line at the 20% level, which represents the target return that we selected. And that happens at well, here it's called cumulative relative frequency, but that's really the probability. It's the probability of 50%. So that means the portfolio will achieve this 20% return over 1 year with a probability of 50%. I'd like to also show some of the data here. Over on the left, you see the portfolio. Data for the portfolio is shown in the top row, and data for the securities is shown in these other rows. Notice that the weightings are organized from top to bottom, with the highest weighted securities at the top. So in this case, the weight for TLT is about 42%. That means that the portfolio should have 42% of cash put into TLT. Almost half, you could say, goes into this very low volatility stock. And as you look in the successive rows, you see 32% is put into QQQ, and about 17% is put into Apple, and only 9% is put into NVIDIA. And that is kind of an interesting result, because NVIDIA has been such a big earner for quite a while now. You would expect that the optimizer would put a lot of your cash, or would recommend that a lot of your cash go into NVIDIA. But because the standard deviation for NVIDIA is very high, the allocation is very low. Standard deviation here is a measure of the volatility, and the Markowitz Modern Portfolio theory will try to avoid selecting stocks or allocating a lot of money to stocks that are highly volatile. So here, the weights decrease as you go down the rows, and standard deviation decreases. The standard deviation of the portfolio is 17. The optimizer chose the securities in such a way that the mean of the portfolio would be 20, which is what we requested. In order to achieve 20%, it had to, roughly speaking, it had to give us a combination of these two securities, because about 70%, almost 75%, is put into these two securities. They have a standard deviation of 0.12 and 0.19. So that gives us approximately a standard deviation of 0.17 for the portfolio. These have higher standard deviations, but like I mentioned, the optimizer tries to avoid allocating much cash to those. So the cash allocated to Apple is only 16%, and the cash allocated to NVIDIA is only 9%. Now, let's scroll down and look at the 5-year results. We will skip the return graph, and we will look at the IRRP graph, is what we call this. And we use the same method to determine what the probability is of achieving 20%. And that would be 20% for each of 5 years. What you do is you look at this purple curve, you see where it crosses the vertical green dotted line above the 20% level, and you see that the probability here over on the left is only 40%. So that's what I meant when I said it's more difficult to achieve 20% for a portfolio that you're holding for 5 years, and you expect to get 20% for each of those 5 years. Essentially, the optimizer had to choose a more risky portfolio, and that means the probability of achieving 20% is lower than it was in the case of a 1-year portfolio. So moving down to this table, you see that again the allocation of the securities is arranged from highest to lowest as you look down the rows. And again, the optimizer was able to achieve a mean return of 20%. However, some higher volatility stocks are selected to achieve this 20%. QQQ has a standard deviation of 0.7 here. Apple has a standard deviation of 0.16, and you see that the portfolio has a standard deviation of 0.05. I think you could say that that is a combination of 0.05 here, 0.16 here, 0.07 here, and actually very little cash is put into NVIDIA. So this standard deviation plays a very small role in the standard deviation that you see here. All right, so that's it. That's what I wanted to discuss in this video. Please visit our website. That's rrptechnologies.com, and try out these tools. All of them are free. And thanks for watching.